Hello everyone, and welcome to Virginia International University's MBA 636 Managerial Accounting course. Tonight we're going to talk about Chapter 3, which deals with job costing. And what we'll cover and talk about during this session are the differences between job costing versus process costing. We'll talk about this idea of manufacturing overhead and how it's allocated, and then we'll work through some examples of each one of those different types of scenarios. So next we want to talk about the difference between job costing and process costing. And when we say job costing or process costing, what we're really talking about is the process or methodology by which we assign cost to particular cost objectives. And as just a reminder, in Chapter 2, if you recall, we discussed the idea of direct versus indirect cost, and we talked about the idea of a cost objective, with the cost objective being some singular activity that we want to accumulate cost against and know how much it's costing us to perform that activity. And we can do that one of two ways, either through job costing or through process costing. And so process costing is generally used where you have mass production. And we have examples here like paint manufacturers, oil manufacturers, cereal manufacturers. It's where one unit that's produced is the exact same as the last unit. And so you don't need to know how much it costs to produce that unit versus the prior unit versus the previous unit before that. And good examples of that are like paint manufacturers or oil refineries. So barring product line differences like premium versus regular fuel, the cost to produce 1 gallon of fuel versus the gallon of fuel next to it are not items we need to track individually. We just need to understand what our cost is to produce that lot of fuel. And so process costing gets us to this. And so again, it's generally used with mass production. It's where we have very similar items. There's not a lot of distinction between the product that might actually cause one item to cost more than the next item. And we just see where we have total costs are averaged over all the units produced. And so that versus job costing, where we have unique custom products or small batches, and think of that in terms of like custom home builders, right? So you would want to know how much the 15-room house cost you to manufacture, even if sitting right beside it, or to build, even if sitting right beside it, you're building a 10-room house. That's why we have items like when you go to buy a house, you have upgrades where you can choose a higher quality or a difference in some sort of standard product. Like the countertops. So do I want standard countertops? Do I want granite countertops? Do I want imported granite tops? Do I want quartz countertops? But essentially with job costing, what we're saying is that the total costs are accumulated by job. So I literally track my costs by each job, and I define what a job is. So a job might be a car that I'm manufacturing. It might be the house that I'm building. It might be the yacht that I'm building. It might be a project I've been awarded by a client where I'm not making anything, I'm providing a service, and I want to understand what it costs me to provide all of the services necessary to meet the deliverables required of a project I've been awarded. So process costing versus job costing. Let's look at a couple of different examples again. So what would you think? A manufacturer of fiberglass insulation. And so there, think about, so the fiberglass insulation, it's rolled out in sheets, or it's sold by lot, to where you have a lot of commonality, a lot of similarity between one roll of fiberglass insulation and the next roll of fiberglass insulation. And if you thought process costing, that's correct. Then we look at this idea of a residential plumbing contractor. Well, so then you say, well, what is it? Is the services that they're provided, how likely are they going to be the same from one job or one cost objective to the next? So I go into one client and I have to unstop a sink. I go into another client and I have to replace the sink and the pipes. Right, so this idea is something where the cost could change substantially from one service offering or job to the next. And so if we thought job costing, we're right there. So how about the manufacture of fiber optic cable? So there again, you think about that cable in fiber optic cable, where 1 foot of cable, fiber optic cable, is the same as the 2nd foot of fiber optic cable, is the same as the 3rd, is the same as the 3,000th foot. And so there we are not so much concerned about what each length of fiber optic cable cost us. And so we should be thinking process costing in that case. Custom home builder, we use that example, right? So one home is not going to cost as much or the same, most likely, as the next. And in that case, the cost, the per home cost may or will definitely influence the price that I'm able to sell it at. And so we have differences between the homes that are built, which gets us to job costing. And then hospital is the same thing. If I go in and I have a broken arm, it's going to likely cost me much less to have that broken arm mended than it is if I go in and have to have open heart surgery. So each one of those service offerings to fix a broken arm or to repair a leaking heart are separate job cost or individual job activities. So I hope walking through those few examples made sense to you, and that you can kind of now, in your mind anyway, envision the difference between process costing and job costing. So now let's talk about how the flow of production and how direct materials and direct labor are traced to jobs, right? And so this is really any job, whether you're costing it via job costing or process costing. We use direct materials, right? That's the materials that go into each individual job that can be traced to an individual cost objective. And so that's how we get the idea of direct, right, materials versus indirect. And indirect labor, again, it's the labor that I use to build the house or the labor that I use to manufacture the product that I want to trace to a specific job. That is direct labor, okay? And so in this process, you can see that we have to engage in a purchasing process so that we can purchase. It doesn't matter whether it's materials or direct labor. In this case, we're talking materials, but we also have this purchasing component up for direct labor. So purchasing determines the ordering needs, right? And this is generally built off of a bill of material that identifies all of the different types of direct materials that go into a single unit. Then they'll issue a purchase order, and this is generally after they've gone out and competed the job to try to get the best price for whatever quantity of the item that they need. Then shipping and receiving prepares the receiving report. Thus the product is delivered to our door, and shipping and receiving has to somehow acknowledge that they received it. The receiving report goes to accounting. The invoice comes in from the vendor to the accounting sometimes. Sometimes it will go into the purchasing department, but the invoice is matched with the purchase order, and it's also matched with the receiving report to make sure that a couple of things we're checking there. One is, did we receive the quantity we're being invoiced for? And we rely on what we call third-party independent documentation. That is the receiving report to tell us the number of units we got is that is the number of units we got. And then we compare the invoice to the purchase order to know that, well, that's the per unit cost that the purchasing department agreed to, that they issued the purchase order to, that the vendor can bill us at, and then accounting pays the invoice. And inherent in this process, and you'll probably talk about it in auditing class that you go through, is this idea of segregation of duties, to where you have these independent segregated functional roles that perform these duties so that you minimize the likelihood of fraud. And so next we want to talk about this idea of manufacturing overhead rate and how we allocate it to jobs. And when we're talking about manufacturing overhead, this is obviously in a manufacturing industry. It could be in a services industry also. It would just generally be referred to as overhead, and you might have an office overhead or field overhead depending on where your staff are located. But essentially this overhead we think of in terms of indirect cost, right? So we talked about direct cost. Overhead is talked about in terms of an indirect cost, and the allocation process, or the way of spreading that bucket or accumulation of cost across all the jobs that receive a benefit from those overhead activities. And this idea of spreading it is based on some sort of allocation base. And so we'll talk a few minutes about these concepts a little more. And so to calculate what we call a predetermined manufacturing overhead rate, we take our total estimated manufacturing overhead cost and we divide it by the total estimated amount of the allocation base. And we'll talk about an example of this in a moment, but what we're essentially doing is accumulating in this bucket these overhead costs that benefit they provide a benefit to multiple different jobs, right? Multiple different projects, but they're hard, or there's no cost benefit to breaking out these overhead cost items and charging them directly to jobs. So we put them in this bucket, we put them in this capture of overhead accounts, and then we spread that based on some allocation base. And there's no one universal allocation base that must be used in all cases. The allocation base, and this is very important, and I want you all to think about this and remember it, the allocation base should have a causal relationship to the overhead costs that are used to spread it, okay? And so, for instance, if we talk about direct labor, right? So that's labor that I charge directly to a job. But in most industries, and in most organizations, we have to pay for employees' medical expenses and dental expenses and life insurance and disability perhaps. And, well, it's not very cost beneficial to determine for each employee how much we pay for medical insurance. It's not very cost beneficial for each employee to determine how much we paid by hour for each of their different types of coverages or fringe benefits, and then charge that out to each job along with their hourly rate as a direct cost. So what we do is accumulate all of those types of costs into a fringe pool, which is a type of overhead cost. So we accumulate them into a fringe pool, and we generally will spread that based on using an allocation base of direct labor dollars. So that suppose I hire an employee and it costs me $20,000 a year, but I also have to pay out $3,000 a year to or $4,000 a year, we'll say, for fringe benefits. And again, we say fringe benefits are things like health insurance and disability insurance, medical coverage, dental, life, those types of expenses. Well, so it costs me $4,000 for that employee, and I'm paying them $20,000, then 4,000 divided by 20,000 gives me 20%. So for every dollar I pay them, I'm paying another 20 cents in all types of fringe benefits. So when I charge $1 of their time to a job, I also charge 20 cents more along with it in order to allocate all of those fringe benefits. And manufacturing overhead rate works along the same lines. It's just a different type of cost. So think of manufacturing. Fringe generally we think of as service industry manufacturing. We think of things like my production line. So suppose, it doesn't do me any good to charge each unit I manufacture with how much it takes me to clean the machines each night, or to oil the machines, or for certain low-cost consumables that the machines just use in the course of running the production line. But if I accumulate all those costs and I create this bucket, and then I determine perhaps my allocation base in that example is the number of units produced, and so I accumulate that bucket of costs that are indirectly associated with the manufacture of those numbers, of that number of units or that production lot, and then I spread it across each unit using an allocation methodology. And so we see that to allocate manufacturing overhead, we just simply take the predetermined manufacturing overhead rate that we saw how we calculated it in the prior slide, and we multiply it by the amount of cost allocation activity used, or whatever our base is. And this is another example. So, for example, the total estimated manufacturing overhead costs are equal to $1 million. The cost allocation base is direct labor hours. So what that's saying is that I'm going to allocate my manufacturing overhead out over my direct labor hours. And I say that my total estimated direct labor hours for the year is 62,500 direct labor hours. And then we'll just say, for example, job number 603 used 500 direct labor hours. So first we have to determine what our predetermined manufacturing overhead rate is. So think about this for just a minute, and based on our previous slides, how would we calculate that? And I hope that you're thinking that it's the estimated manufacturing overhead cost divided by the direct labor hours, or the estimated direct labor hours for the same time period. which is exactly what this formula is. And so we can see that the math on that says that I'm going to allocate my manufacturing overhead out at the rate of $16 per direct labor hours. So what's that mean for job 603? So we have $16 an hour, right, which is what our predetermined manufacturing overhead rate is, times the 500 direct labor hours that we incurred on job 603 to give us a manufacturing overhead allocation to job 603 of $8,000. Very good. So I hope that makes sense how we got to that. And so here we just use this to illustrate when is manufacturing overhead allocated. And so it's really allocated as a function of the build-up in our work in process as we manufacture products. So our direct materials are treated as, our materials and our labor are treated as direct. And so as we build product, we charge that cost of those direct costs into the work in process account. We also have indirect flows from labor and materials, and again, these could be materials include everything, right? That direct and indirect. So maybe it's the oil on the production line used to maintain the machinery. The indirect labor, maybe it's the maintenance and the janitorial services used to maintain the factory warehouse space. So those get put into a factory overhead pool. We then go through the calculation where we get this predetermined manufacturing overhead rate, and we allocate that to work in process. And then as we move or finish, we move the cost of that work in process into our finished goods. And then as we sell that product, we move it out of finished goods into cost of goods sold. And so this is really just meant to show the illustration we have coming into work in process, this idea of direct materials, direct labor, and manufacturing overhead. And that's what comprises our work in process account. As we complete the work in process and it goes into inventory, for sale, we move that out and into a finished goods inventory. And then as we sell the product, we move the cost of those finished goods that are sold into cost of goods sold, right? And so work in process and finished goods are balance sheet accounts. Cost of goods sold are income statement expense accounts, and they're going to be obviously offset with the revenue that we get from selling those finished goods. So now we want to talk about how, once we've determined the cost of a job, how do we use it to make business decisions, right? Because what we have to talk about there is pricing implications, profit implications, competitiveness implications. And so these are some of the reasons why management needs product cost. And this is a big area for, in managerial accounting, is determining what product cost is, because it's rarely clear, black and white, and it often makes a big difference in how we treat certain costs as direct or indirect, or what the allocation base is over which we allocate cost and what's fair and equitable, particularly when you're in a manufacturing environment where you have multiple product lines being run in the same factory. So we want to reduce future job cost, right? So how we allocate might have something to do with how we are able to better control our cost and where it makes sense that they reside. And so for product A, it may make a difference as to what it costs depending on the allocation of manufacturing overhead versus product B. We also want something that will allow us to assess and compare profitability of models. Again, we talked about pricing decisions, right? So how what I consider to be direct versus indirect, how I allocate my cost will impact what it costs me, and which will in turn impact my pricing decision, which is in turn also a function of what my competitors are doing. We want to understand this often drives discussions about high volume sales and how we allocate cost with respect to one-off sales, bids for custom orders, financial statement preparation. And so when we talk about sustainability and job costing, we're really talking about the fact that job cost records capture the essential resources required to manufacture a product. They can be enhanced with information about the effect on the environment, the employees involved in the manufacturing process. So what about our staff, our future customers, and then future disposals? And then we also talk about subcategories and extended producer responsibilities. And all of these items deal with sustainability. And we're increasingly seeing, as consumers become and as organizations are forced to become more socially conscious and assume more social responsibility, we're seeing how this idea of sustainability is really becoming much more prevalent in industries. And so it's not all right any longer to just pollute the environment and not realize the cost on society. It's not all right to take advantage of employees and not to create a better employee or a more self-sustaining employment environment. And so all of these are the important when we're looking at sustainability, right? Because we want a long-term solution to our resource problems, and job costing can help us sometimes by providing insight to that. So then we want to talk a few minutes about this idea of over-allocated or under-allocated manufacturing overhead. And really what that has to do with is, we talked up to this point about how we allocate costs. This idea of over-allocated or under-allocated really means, well, did our product bear more or less overhead allocation than it should have, given either the estimated cost of that versus the actual, or the estimated allocation base amount versus the actual? And so probably the best way to do this is through an example. So if we look at this, we can look at FedCorp. It allocates manufacturing overhead costs, again, based on direct labor hours. The estimated manufacturing overhead for the year is projected to be $200,000. The total estimated direct labor cost is estimated to be $140,000, while the total estimated direct labor hours to be worked are 10,000. So first we have to determine what the predetermined manufacturing overhead rate is. So again, we know that it's allocated based on direct labor hours, so that's going to be the allocation base. And we know that the manufacturing overhead for the year is projected to be $200,000. So knowing that, I think you can understand, or you can pretty much quickly come to what this overhead rate is. And we see that at the bottom here. So the projected overhead rate is equal to the $200,000 in projected overhead divided by the 10,000 direct labor hours, which gets us to $20 per direct labor hour of predetermined manufacturing overhead rate. So that's our projection, right? And so we allocate it out through the year, because we got to do this through the year. We allocate it out based on $20 per direct labor hour. Now, how does that compare at the end of the year now when we look at it to what our actuals ended up being? So FedCorp's actual manufacturing overhead for the year was $190,000, with a total of 11,000 direct labor hours were worked. So essentially, we had $190,000 in manufacturing overhead, and we had, which is less than what we projected, and we had a total of 11,000 direct labor hours, which is more than what we projected. So using the predetermined overhead rate of $20 per hour, how much was allocated to FedCorp's jobs during the year? And so through the year, as we allocated $20 an hour, right? And we had 11,000 hours that we incurred. Right, we're given 11,000 hours, so we would have actually allocated $220,000, right? And we get to that by multiplying the $20 that we allocated, the predetermined manufacturing overhead rate, to the actual number of direct labor hours worked of 11,000. So now we look at what to do when manufacturing overhead does not equal allocated manufacturing overhead, and that's exactly where we are now, right? We estimated $200,000 in manufacturing overhead. It actually came in at $190,000, right? And so to answer this, we need to know what FedCorp's actual overhead was. We need to know what FedCorp's allocated overhead was, and the difference between those two becomes our over or under allocated manufacturing overhead. So their actual overhead, right, was $190,000. What we allocated that we just talked about, $20 times 11,000 hours was $220,000, which gives us a difference of $30,000. So think about this before we get into the discussion a little more, is that if I allocated $220,000 of manufacturing overhead, but I only incurred $190,000, am I overallocated or underallocated? And I hope you were thinking overallocated. Right, so we have target was 190, we actually allocated 220, so we've over applied $30,000 worth of overhead. One, our overhead was less, right? The actual overhead was less. And secondly, the actual number of direct labor hours incurred was more. So we had changes in the denominator and the numerator. So whereas we have an underallocated example, we're undercosted, right? We just looked at where we were over applied. You could also be going in the other direction, and you could easily understand that. So suppose, the opposite happened. My actual overhead ended up being $220,000, and I only produced 8,000 units, but through the year, I allocated at a cost or a predetermined manufacturing overhead rate of $20. So in that case, you can see that my costs were higher, my units were lower. And if we just do that quickly, we say 220,000 divided by 8,000 units gives me $27.50. That's $220,000 in overhead divided by 8,000 units gives me $27.50 worth of per hour direct labor hour manufacturing overhead. So instead of having allocated $20, I should have allocated $27.50. So I'm underallocated in that example. So we talk where it's not enough allocated to jobs. There's too little expense, right? We didn't recognize enough expense. We projected $200,000 at the beginning of the year. It actually came in at $220,000. Versus overallocated, where we're overcosting, we have too much allocated to jobs, we have too much expense, right? Because when we're doing this, we're booking our journal entry hits expense, so we have too much expense associated with our process under that scenario. So we end up, how or why do we have underallocated or overallocated manufacturing overhead? And that's because estimated manufacturing costs were higher or lower than actual, right? So the 200,000 versus the 190,000 or versus the 220,000. We may have used more or less of the estimated allocation base than projected. And so there are two solutions with respect to this. One is that we just adjust our cost of goods sold. Or secondly, we prorate between cost of goods sold, work in process, and finished goods sold. So we have two different solutions, and generally what drives the solution here is the level of materiality. Right, so the more material the difference is, the more we are inclined to split it up between cost of goods sold, work in process, and finished goods. Because it really isn't, cost of goods sold is an income statement account. It's treated more or less as a period expense. And if it's very material, it really should be held up on the balance sheet until those units are, or between the balance sheet and the income statement until the units are all fully sold. Now, according to GAAP, all we can do is inventory product cost, and inventoriable product costs are added to the cost of assets or inventory. But for internal decision making, we want to know what the total cost of the production is across our value chain. So, there are these sometimes, and this is managerial accounting. Again, we get back to the difference we talked about in Chapter 1, the difference between managerial accounting and financial accounting. Right? We may want to know what the cost of a product is, but yet on our financial statements treat those costs a different way. So here we're just going to walk through quickly the journal entries for a manufacturer's job costing system. When we purchase materials, right, so when we purchase materials, in this case we purchased $90,000 worth of material, we debit raw materials inventory, which is an asset account, and credit accounts payable. Right, so we've purchased our materials. And so here now we're going to move material out of raw materials inventory into the production process. And so there we simply debit work in process inventory, which is just another inventory account on the balance sheet, and we credit raw materials inventory, which is again just another asset account. We're just moving it between two different asset accounts to record the use of direct materials on jobs. And so here all we're doing is moving, again, we're moving out of the manufacturing overhead account and out of the raw materials inventory account to record the use of indirect materials in the factory. Right, because these indirect materials are they're just another asset, right? It's just, you can see before where we might have been moving the materials cost into a work in process account. Here we're moving it into a manufacturing overhead account pending allocation. And so this example, again, we're to record the use of direct labor on jobs. So people fill out their timesheets, they identify a job, the job code, while the material or the inventory is being built, the debit goes to work in process, and we create a wages payable or a liability account until we pay the wages, which just simply then credits cash and debits this wages payable account. And so here again now we have some indirect labor, so maybe these are people cleaning the machineries or performing maintenance on the machineries, maybe it's plant security, right? We don't attach them to the work in process because it's not cost beneficial to break them down to that level. So we throw those costs into a manufacturing overhead account and credit our wages payable account until they're paid. And then this just illustrates accumulating or incurring other manufacturing overhead costs, and it gives you some examples. So the electric bill, depreciation on the plant and equipment, prepaid plant insurance, or property taxes payable. All of those are credits, and they're all being accumulated and housed in this manufacturing overhead account pending the allocation of it out over the allocation base. So here we're going to talk about how we allocate it now. Job 603, we allocated $16 per direct labor hour, and we're assuming 500 direct labor hours. So we allocate out manufacturing overhead of $8,000 to that job. Job 604, $16 per hour times 1,000 direct labor hours, and so we're going to allocate $16,000 out to job 604. So combined, we're allocating out $24,000 against these specific jobs based on the direct labor hours they've incurred at some predetermined manufacturing overhead rate of $16. So there we're debiting then the work in process account and we're crediting the manufacturing overhead account. And here you can see the at the completion of the jobs, we can see this job ticket where we show we have direct materials of $72,000, direct labor of $20,000, I'm sorry, manufacturing overhead of $16,000. So we have a total job cost of $108,000, which is spread across 60 units that was completed for that $108,000. So the cost per unit is $1,800. We're ready to move these jobs out of work in process into finished goods inventory, and so we debit finished goods inventory, which is one asset account, and we credit work in process inventory, just another asset account, in order to move them into finished goods inventory. Then we have the sale of the units. And so we're assuming that we sold 40 units for $1,425, and we sold another 60 units for $2,500 to give us a total sales price of $207,000. And we sold them all on credit. We didn't sell them any on cash. So we debit accounts receivable, which is an asset account on the balance sheet, and we credit sales revenue of $207,000, which is a revenue account on the income statement. to record the sale. Then we also have to move these goods out of finished goods inventory and into the out of the inventory account, because we no longer have them as inventory. We sold them, and so they become cost of goods sold to us. And we do that so we have 40 units that are sitting in our finished goods at $1,160 per unit, and 60 units that are sitting in our finished goods inventory at $1,800 per unit. So combined, we're moving $154,400 against the expense account, cost of goods sold, on the income statement, out of the finished goods inventory account on the balance sheet. And so then we have these other non-manufacturing costs that we have to expense. So these are general and administrative type expenses. So they're expenses in addition to the manufacturing overhead, or the costs that went into our manufacturing overhead rate, but they're not the same as those costs. They're selling, general, and administrative expenses, and these are just examples of them. So salaries and commission expense is a debit, rent expense is a debit, marketing expense is a debit, and they're all going into payables accounts pending the actual cash payment of them. That's why they're all credits. And here we're going to close out manufacturing overhead. And so what we're saying here is that this is how one of the methods you remember was to just charge any differential, any over or under allocated manufacturing overhead to the cost of goods sold account. The other was to spread it between cost of goods sold, work in process, and finished goods. And in this case, because of the immaterial amount of it, the decision was made to spread it across cost of goods sold. So we debited our cost of goods sold for $1,000 and credited our manufacturing overhead for $1,000. So this is a very simplified example of the income statement that then gets generated as a result of those journal entries. Revenue of $207,000, lesser cost of goods sold of $155,400 gets us to gross profit. Lesser operating expenses of $32,700 gets us to our operating income of $18,900. So again, just a very high-level, simplified version of an income statement if we follow those journal entries that we just reviewed all the way through to the end. And so here we talked just a few minutes about using job costing at a service firm as a basis for billing clients. And I would encourage you to spend a little time on this in the chapter, because as a knowledge economy, we move more and more toward service environments and less into a manufacturing environment. So, the concepts are very general or similar. It's just they sometimes have a slightly different twist to them. So it's similar, we say it's similar to job costing at a manufacturer. The main difference is that the company has allocated indirect period cost to each client rather than manufacturing cost. And so, again, it's just a matter of what makes up our this overhead that gets allocated. And when you're talking to service companies, sometimes the mix of those costs is very different than when you're talking to manufacturer. Right? And it could be that here we're talking it's allocated to each client. It could be that's allocated to each job, right? Versus each unit of production in a manufacturing environment. And so since we have no inventory, no journal entries are necessary. And so that takes us to the end of Chapter 3. I hope this was helpful. I encourage you to please go back and read the chapter and make sure you're comfortable with it and very familiar with it. And I look forward to the next topic we're going to discuss in Chapter 4. Thank you.